financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
All right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride. As you heard, my name is Jerry Robinson, an economist, trend trader, trend trading coach here at followthemoney.com, and very, very happy to be on today's podcast. We have a lot to talk about today. As you see, today's title, Inflation Nation. Although inflation keeps easing, we've been all battling this inflation now for a long time. It seems like many, many, many months, ever since the COVID situation started a while back. We're going to be talking a little bit about the latest CPI report that came out this week on Wednesday. We're seeing inflation ease even more as we continue to see these rate hikes working their magic here at the Federal Reserve, doing their thing. So we're going to talk about that. We're also going to talk a little bit about the Fed's latest rate hike, as I had mentioned, what we see going forward. We've also going to talk a little bit about the debt ceiling debate. I mean, again, just a wild time we're in here. And then also a little bit about the banking fears. We got a question from a member whether, bank deposits are safe. We're going to try to address that. We'll also try to squeeze in a little bit of a market update as well. There's a lot going on in the markets as we look around. But great to have you here. Follow the Money Radio. We were just talking with one of our listeners and who was listening to this show way back in 2011. One of the longest running financial podcasts anywhere. Follow the Money Radio. Great to have you here. If you're new, we're so glad to have you. You can find us online at followthemoney.com. We have lots of free resources. And then, of course, we have a whole member section for those of you who really want to get access to our research, trading ideas, investing ideas galore, education, ongoing education on how to become a better trader, better investor, all that there for you, followthemoney.com. All right, so let's begin with this latest report here. We got the latest CPI report. That simply means the Consumer Price Index. That's the official inflation rate here in the United States. Now, of course, it's not perfect. Of course, the CPI is going to leave some things out. It's going to misrepresent some things. So you got to keep that in mind. We're not talking about a real inflation rate. We're talking about the official inflation rate, but that's what we got to go with here. I mean, that's what we're using. That's what the government uses. That's what we're all measuring as we look. You can also calculate a real inflation rate, but you'll also notice that it's also been coming down slowly but surely. So this morning's monthly CPI report for the month of April revealed that the annualized inflation rate slowed to 4.9%. That's the 10th consecutive month that we have seen the inflation rate here in the United States fall, and that's a 4.9% year over year print. That's slightly below March's 5% rate, and it was also below market forecasts. Analysts expected a 5% year over year inflation rate in the month of April. We actually got 4.9%. So we haven't seen the official U.S. inflation rate experience this many months of deceleration in well over a century. You got to go way back to the early 1900s, 1910 or something, to find this kind of deceleration going on. Now, it makes sense because we've just had, incredible amounts of, spiking of the Fed funds rate. So the interest rates have gone up. The Fed has raised rates numerous times, 10 times or so. And what their goal was to get the Fed funds rate above the annualized inflation rate, and now they're there, right? So they've got the Fed funds rate at 5.0 to 5.25. I think that's the target range, and then you have the inflation rate of 4.9%, so just slightly below. So we expect the Fed now to pause where it's at. We'll talk about the latest rate hike in a minute, but we expect the Fed to pause here and not to continue raising interest rates through the summer. They're certainly seeing their desired effect take place and cool inflation at a slow but steady pace. We're certainly seeing that. You got to keep in mind, too, for those of you who watch this inflation rate and you pay attention to the CPI numbers, we're going to see a pretty big drop-off in year-over-year numbers as we move forward, especially when we get to, say, May or June, where June was like 9.1%, on inflation. So we're going to start seeing some pretty big decreases overall when it comes to the actual hard figures. Now, the official inflation rate at 4.9% or whatever it is year over year is still elevated. I mean, it's historically elevated. But as we mentioned, it's well off of those peaks that we had last year. And we currently expect the annualized CPI inflation rate to fall to around 3% by the end of the year. That's not going to be the 2% target that the Fed has been, talking about for a long time. But we do expect that it's going to get down to about 3% by the end of the year and probably continue to fall, throughout 2024, all things being equal. So the CPI report caused the market to rally. I'm doing this podcast this episode on Wednesday morning. So just after the report was released, we saw the markets rally on the news. We saw, not only stocks rise, but then we also see a few commodities on the rise as well. I want to talk about sugar, by the way. The price of sugar has been incredible. In fact, it's just breaking out now this morning after the CPI report to a new high, 11 or 12-year high. We haven't seen this in a while. And the reason why that's important is because we've been telling our members about sugar since we alerted them back in March, early March 6th. And since that time, sugar has just been on a tear. It's been at the top of our ETF leaderboard. For those of you who like to trade, we track and we rank ETFs. And so, paying attention to the top ranked ETF is really great for those who like to trade. And it's a real quick way to find out what's trending. And, the sugar ETF, CANE, appropriately named, has just been on a tear. In fact, it just hit a new high for 2023, and it's our number one trend leader in our ETF leaderboard for many, many weeks now. 6 weeks, 7 weeks, something along those lines. It's up, 30, 40% since we alerted members back in early March. Lots of positive fundamentals for sugar. I mean, many people don't realize that sugar is not just a food. Everybody, eats sugar, but then there's also the fact that it's a fuel. In Brazil, for example, Brazilian ethanol, they use sugar to create that. And so there's a lot of global demand for sugar, especially as we have a growing population, rising incomes, rising middle class. People want sugar, and sugar, even with the sugar substitutes, sugar is still in big demand. So anyway, long story short, sugar on the run, our number one ETF leader for now 6 or 7 weeks in a row, just continues to move higher. So we are getting the market volatility that we expected after the CPI report. So markets did rally. We don't know how they're going to react throughout the whole day. Other information could come out. But overall, we think this bodes well for the Fed's efforts when it comes to raising interest rates. We also think it's good news for consumers, seeing inflation, official inflation fall year over year. Even though on a month-over-month basis, it's still kind of creeping higher in some ways, many things have really come down, and that's really helpful. Now, the Fed, before the CPI report came out, just last week, the Fed raised its federal funds target last week by 25 basis points, and that's the highest level we've seen. It raised it to 5 to 5.25%. It's the highest level we've seen since 2007. And that decision was unanimous. It came in line with market expectations. The official policy statement that the Fed put out suggested a pause, suggested that it would pause at this point. It scrubbed some of the language in the statement that they had released in months prior, that suggested that they were still concerned. So the Fed has delivered exactly what the markets were expecting. The markets reacted well to that overall. Now we expect, now that the Fed has raised interest rates to that, what we think is a terminal level, about 5% or 5.25%, that range, we expect now that the Fed is going to pause. If you look at the futures market, you'll see that it's exactly what the futures market is expecting as well. In fact, if you go out in the month of June, which is the next Fed meeting, no Fed meeting until June 14th, I believe. On that meeting, there's no expectation of a rate hike. But when you go out to July, you're already beginning to see people expect that the Fed could cut rates by July. We think it's probably going to be the September meeting where we'll actually see the first rate cut. And so we expect that by September, or as early as September, I should say, we could see the very first cut. We do believe that the Fed is done with its rate hike cycle. We've been guiding our members through this crazy time of 2022, 2023. We don't issue forecasts flippantly. We don't like to be wrong whenever we put stuff out, and so we don't make a lot of outlandish, forecasts. But we feel confident. We've been feeling confident that things are moving in this direction, and we're continuing to see it confirmed. So we do expect the Fed to begin cutting as early as September, and that's good news, I think, for everybody, especially the banks. The banks have been in a tight spot here. Banks have been suffering from the higher rates. You say, well, isn't that good for banks? Well, they piled into so many bonds in the wake of COVID, and then when the rates started going up, it caused a lot of pressure on their balance sheets. I want to get all geeky on all of that. But the point is that banks are really kind of looking forward to seeing a little bit of relief in interest rates, which will cause the value of their bonds to go up, right? So when rates go down, bonds values go up, bond prices go up. And so that's, there's a lot there. There's a lot more complicated than that. But the point is that, banks have had a tough time. And we received a member question just the other day from one of our platinum members who was asking, should we be concerned about keeping money in the bank? In fact, there was a poll that was put out by Gallup. There was a telephone poll that showed that, the question was asked, how worried are you about the safety of money that you have deposited in banks? Nearly half of the people who responded said they were very worried, or at least moderately worried, that their bank deposits were unsafe. That's the highest level we've seen since the 2008 financial crisis. And it's understandable. I mean, we've seen Signature Bank, Silicon Valley Bank, First Republic Bank, many of these pretty big banks, just nosedive. Pretty wild what we've seen. And if you're concerned about the safety of bank deposits, a couple things that I would say, this is what we said to the member who had written in, was if you have less than $250,000 deposited in a bank, and that account that you have it in is an FDIC insured bank, well, then you're insured. No depositor has ever lost a penny of insured deposits since the FDIC was created in 1933. As long as you have money in an insured account in an insured bank, well, you're going to be covered. Even with all the bank collapses we saw in 2008, that was true. Even with the bank collapses we've seen this year, that's true. However, if you have more than $250,000 on deposit in a single bank, I think you'd be wise to diversify that excess capital by opening another FDIC insured account at another bank, or maybe even think of something else. Banks aren't the only places to put money. There were 564 bank failures from 2001 to 2023. So far this century, we've already seen 564 bank failures. But when you look at other financial institutions, you'll notice that you don't have that same number. So banks can be a little more prone to problems than, say, life insurance companies, far less prone to financial collapse due to stricter capital requirements, right? So those with extra cash who are a little jittery with having money in the bank, you can always think of other places. So you can think of life insurance companies instead of banks. I like to think of life insurance, well-run mutual companies, not stock life insurance companies that are beholden to stockholders, shareholders, but mutual companies that are owned by policy owners. If when you look back over time, you see really good track record relative to, say, banks. So if you're trying to find a good financial storehouse and you're between a bank, and a life insurance policy, and you have excess money, well, consider, I would say, something else like life insurance. You can also think of hard assets like raw land or gold. Those, of course, have their own situations, their own circumstances, their own risks that you got to consider. But, just don't think of banks as the only financial storehouse. I think that's one way to kind of that's something to take away from the current problems that we have now. And, the thing is, though, you got to remember, we are facing massive, gargantuan long-term problems here in the United States. If you don't believe me, read my book, Bankruptcy of Our Nation. You can find it on Amazon or our website, followthemoney.com/bankruptcy. I wrote that book back in the wake of, well, actually it was before the 2008 crash, but it came out around the same time as the crash. And I was warning about that crash. It was obvious that it was going to happen. And we were writing about it, trying to tell people about it. And in that book, I explained, some of the big problems, the fiat money system that we have, the fractional reserve banking. I mean, a lot of this stuff has become more common knowledge now today, especially because of things like Bitcoin, which has turned people on to understanding money a little better. We do have long-term problems, real serious long-term problems. But I don't think that automatically means that you should fear the imminent collapse of FDIC insurance, right? So what I say is that I expect Washington to covertly inflate away the U.S. dollar's value way before it's forced to overtly shoot itself in the foot and destroy faith in its own fiat empire, right? So it's not looking for ways to destroy FDIC insurance. That's the whole thing is based upon faith. So I think that individuals should just take personal responsibility for their finances, right? That's why we teach here so many of these lessons over and over again. Our 5 levels of financial freedom. Followthemoney.com/5 levels. We teach you the 5 levels of financial freedom, how to break free financially, giving and saving and investing and creating multiple streams of income. You don't want to let financial fear control you. We see a lot of that today where people are scared. And it's understandable that you would be concerned about what's going on, but that's not going to help you, right? Fear is not going to help you at all. Fear is not in any way, shape, or form going to better you. It's not going to improve you. It's not going to improve your finances. So fear is not a good motivator. It may be a real motivator, but it's not a good way to think. So you don't want to be controlled by fear. And what we want to teach you to do is break free by empowering yourself through personal responsibility, taking control of your own situation, being a good steward of the assets that are in your care. And we're always here to help here at followthemoney.com. Now, let's see. Let me talk about a couple of other things. We got also the big, so we got the Fed out of the way. We talked about the Fed. We don't expect rate hikes, moving forward. In the summer, we expect rate cuts as early as September. Probably a small little sliver, a 25 basis point rate cut, but that'll encourage the markets for sure. Let's see. We also talked about inflation, right? Inflation continuing to fall. We talked about that. And we talked about, what we haven't talked about is the latest jobs report. In April, we had a really strong jobs report, relatively speaking. Employers added 253,000 jobs last month, and the unemployment rate fell to 3.4%. That's a 50-year low. The economists were only expecting 180,000 jobs to be added, but we got more than 250,000. Also, the black unemployment rate here in the United States fell to 4.7%. It's never been lower. So that was a pretty big deal. And also we've seen, just better than feared. I think better than feared is really the slogan for the last year or so. Things just continue. People were, expecting a big recession. They thought everything was going to fall apart. And things just continue. Consumers just continue to show up. They continue to buy things, even with prices going up, right? We also saw home prices fall in a third of the U.S. during Q1. We got a report from the National Association of Realtors that showed that housing prices are coming down. If you're in the market for a house, you've probably seen that. You've probably seen that prices have been coming down, relatively speaking. And that's good news, even though rates are still elevated, mortgage rates. The prices of houses have been coming down, and incentives that sellers are providing are also becoming a bit more rich. Just during COVID, for example, you couldn't get any seller to pay for closing costs in most places. Maybe some places you could, but in places I was looking at, you couldn't find. Sellers were just, it was a total seller's market. It's changing, and you can feel it. If you're in the real estate market, you can certainly feel it. You've certainly seen it. But I'm of the opinion we're going to continue to see this throughout the remainder of the year. I think as we head into the latter part of this year, it may be one of the best times for buyers to buy. So if you're on the sidelines or you're wanting to buy a house, I think every month of this year is just going to get progressively better for you, progressively a little less better for sellers. And so because more houses are going to come onto the market very likely, and more buyers, this is going to be I think it's just setting up for a good setup for for those who want to buy a house. So that's good news on that front. So we've covered quite a bit there. Let's take a quick break. We'll come back. I want to talk a little bit about what's been happening in the financial markets. We'll go through stocks, precious metals, and crypto. We'll be right back. All right, friends, welcome back to the program. I just forgot to talk about the debt ceiling. I want to just squeeze this in real quickly before we get into the markets, because I do want to talk about stocks and ETFs. I want to talk a little bit about commodities and cryptocurrencies as well, just kind of provide a little market update. But before we do, the big question on everybody's mind, will Washington stop borrowing money to pay its bills? This is of course, the media is clutching its pearls, and everybody's wondering, will Washington actually come to a debt ceiling resolution, or are they going to stop paying their bills? Are they going to stop borrowing money to pay their bills? Are they going to stop printing money to pay their bills? Yeah, of course, this is a big joke, because if Washington is good at one thing, it is good at borrowing money to pay its bills, right? And it's also good at printing money to pay its bills. And there really doesn't seem to be any other method that it knows when it comes to paying its bills, right? So it knows how to borrow money to pay its bills, and it knows how to print money to pay its bills. But this idea of actually earning your money to pay your bills, this is kind of foreign to Republicans and Democrats. And so Washington just doesn't seem to understand that. The idea of living within your means just seems abhorrent to our lawmakers in Washington. And they believe falsely that they can get away with this forever. Well, it doesn't matter who's in the White House. You can go back and look at the data. The debt ceiling gets raised. But both sides of the aisle usually like to make it some sort of, they try to benefit from it. They try to turn it into theatrics for the benefit of their side, right? And so right now, that's exactly what we have. We have a debt ceiling debate, and President Joe Biden has called top Senate and House leaders to the White House. He did that this week for a meeting, and Washington's self-imposed deadline is nearing. The debt ceiling, by the way, is the total amount of money that the U.S. federal government is authorized to borrow to pay for programs like Social Security, Medicare, military salaries, tax credits, on and on. The GOP claims that it wants spending cuts, right? And they just passed a bill that targets Biden's student loan giveaway for the wealthy, as they call it. And the GOP is targeting students, but they don't seem to be targeting the $858 billion Pentagon budget. $858, it pains me to say it, $billion Pentagon budget. Can you believe it? Nearly $1 trillion spent on an unaccountable military. Incredible warfare state that America has with no accountability. Pentagon can't pass an audit, hasn't passed an audit, doesn't know where trillions of dollars are. I mean, it's incredible. So nobody wants to take any kind of axe to this budget, right? $858 billion. But no, it's going to be something else, of course. And so, the debt ceiling debacle makes for great political drama. It drives media ratings. But the truth is that Washington has no other plan but to keep borrowing to pay its bills. So we are not going to see lawmakers willingly give up their government credit card for political purposes in order to own the libs or in order whatever they want to do. Instead, if you want the government credit card taken out of the hands of Republicans and Democrats, you're going to have to rip it out of their hands, right? So we expect the debt ceiling to be raised before a default, just as it has 100 times before since 1940. So now, with that out of the way, let's move into the market update. I want to talk a little bit about what's been happening in the markets because we know what's been happening in the economy. We've kind of talked about that. We talked about some of the latest moves by the Fed. We talked about the inflation rate and the unemployment rate. But what about the markets? How are they responding? Well, right now, when we look at the markets, we continue to see an uptrend, right? We continue to see an uptrend, and we follow trends here at followthemoney.com. That's where we get the name. Follow the Money is kind of following the trend action, the price action in the markets. And if you look at the S&P 500, for example, the S&P 500 currently sitting at around 4135 as we're recording this episode. The key area we're watching on the S&P 500 is around 4275. So if we get up to 4275, that's a big resistance level. If we get past that area, that's going to be really bullish for the S&P 500. There's been a lot of bears on the market this year, and it's understandable because whenever you go through a bear market like we did in 2022, people kind of get stuck in that moment, and it takes them a bit to thaw out from that. You know, they see the market go down. And then by the time they finally, believe that the market's going down, the market tends to start going back up. And so it takes a little bit of time for people to process and shift. So we got a lot of bears, in the market, and the market's going up, but many people don't believe it. And that's the way it was back in 2009. That's the way it was even in 2020, where we had the crash and then market started going back up. People said, no, it can't be true. And it just goes back up. And so when we look at the S&P 500, for example, 4275 is the key area we're watching on the upside. If you're a bear, though, if you say, no, the market's definitely going to go down, well, you got to watch that 3491 low that was hit back in October, and we're well off that low. So for all things being equal, the market breadth is a little bit weak. Right now we got about 50% of stocks in the S&P 500 that are participating in this. They're above their 200-day moving average. It's sort of low. I mean, earlier in the year we were up to say 70% of those stocks that were above their 200-day moving average. We haven't seen full participation there. So market breadth suggests that this rally is a little bit weak, but we expect that that's probably going to be filled in by more good data or positive data or better than expected data, better than feared data. If you look at the NASDAQ 100, for example, this one has been on a tear. I mean, since it bottomed back in October, it's kind of skid along that bottom for a little bit, but then it finally in 2023 just took off. We told our members, look, watch big tech, watch crypto. We expect these to lead in 2023, and that's exactly what we've seen. We see Bitcoin. People have seen Bitcoin pull back a little bit in recent weeks. But if you look at it year to date, it's up 71%. Bitcoin's up 71%. Ethereum's up 57%. Okay, there's a lot of stocks that are up too, big time, like Meta, which, Meta, I'm actually typing in this data right now so I can tell you the exact numbers. Right now, Meta is up 94% this year in 2023, right? Rebounding off of that brutal low that it was, that it had seen. NVIDIA is up 97%, this year. That's a really good return after a brutal 2022. Apple is up 33%, this year. So we've seen some really good rebounds in the stock market, and a lot of it has come on pretty big volume. So we've seen some good inflows into the market. Big tech is rallying. We expect that big tech is probably going to continue to rally in 2023. So we remain bullish on QQQ as it is currently sitting at about a 9-month high. Now, key levels on the NASDAQ 100, of course, when we're looking out is if you're trading like QQQ, for example, you still have big overhead resistance way up at $400 where we hit at the end of 2021. So the NASDAQ 100 is still trading well below its previous all-time highs, but it's certainly broken out from its bearish channel and it's been moving higher. Okay, let's look at gold, for example. Let's talk about gold for a minute. So gold has also been on a tear. It recently hit, it surged to a record high intraday. And what's really driving gold is the fact that there's these banking concerns. There's fears about a potential recession that's coming that we keep hearing about, but hasn't materialized yet, or at least we haven't seen it officially. We haven't heard the NBER actually officially declare the inflation has come or the recession has come. We just haven't heard it. And there, as I mentioned to you, I think on a recent podcast, there has never been a more telegraphed recession in my lifetime. Everybody's expecting a recession. Everybody and their dog thinks a recession's coming. Okay, well, that's not how recessions hurt. That's not how you get a sell-off in the stock market later. Now, you may get an earnings recession. Of course, if there's a recession, you may get hit in earnings and you'll see a little bit of a pullback in stocks. But again, there's so many people expecting it that it kind of takes the wind out of the sails of that. So we're not too terribly concerned about the coming recession because everybody is expecting it. Recessions have more power when they come unexpectedly and people aren't expecting them and forecasting them and telegraphing them and claiming and predicting them. So they tend to carry more weight when they kind of come out of the blue. So gold rallying, what's behind the move in gold? Well, gold to me, ever since I've been an investor, I've never viewed gold as an investment. I mean, it's never been an investment to me. It's always been portfolio insurance, right? And based upon the current fear in the banking system, also the fact that the U.S. dollar is continuing to decline, we just think gold prices have more upside in 2023. We had listed precious metals as one of the key beneficiaries we expected this year in 2023, along with big tech and also with crypto and a few other markets. And gold is just continuing to move higher. If you look at silver, let's look at silver too while we're talking about it. Same thing. Silver has been pushing beyond some of those resistance levels that it's at. Silver just closed above $26 last week for the first time in a year. It's got positive fundamentals. It's got, we got global demand for silver rising. We have supply deficits in silver. There's still significant overhead resistance, though, for silver. If you're looking at a chart of silver, you're going to want to notice a few things. First of all, $27 on the upside is going to be a problem. You got to burst through that. And then if you get above that, well, then you've still got plenty of overhead resistance, all the way up. The all-time high for silver was set back in 2011 when it hit, nearly $50. And so, we're trading at half that amount right now. So there's plenty of overhead resistance for silver. But there could be more upside, especially with the tight supplies and also with the dollar, experiencing, a weakness. We continue to expect the dollar is going to continue to go down. We'll talk about the dollar a bit more in a minute. But, when we look across these markets, that's what we're seeing. If we look, let's talk about the dollar. I mean, we might as well. We've just been talking about it. Let's talk about the dollar. The dollar has been really in a tough spot lately because it is basically the dollar goes up when there's expectations that rates are going to go up. But when expectations are that rates are going to go down, well, then that takes the wind out of the sail for the dollar. And right now, we expect that the dollar is going to continue to go down because rates are expected to go down, right? So we're beyond the area where rates were, going to keep climbing and climbing. That was pushing the dollar higher. But now that rates are going down, 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 or we expect them to go down through rate cuts, well, that's bearish for the dollar. And the stock market tends to look ahead 6 months or so. So it kind of prices this stuff in. So we expect that declining dollar is going to be a tailwind, not just for gold and silver, which it usually is, but also for other assets and including stocks. So that's good news there. If you're long stocks or commodities or even cryptos, it's going to help cryptos as well. The Russell 2000 is just kind of grinding sideways. We expect small caps to do well this year, but they just kind of underperformed. The same thing with China. It's been a real big stock pickers market in China. Lots of sideways grind in Chinese stocks. We're bullish on that space longer term. Right now, it's just kind of a stock pickers market. Oil has been kind of down in the dumps. We haven't really seen it rally. It's been coming down overall, and that's been locked in a bearish channel, which is helping inflation, I think, to a certain extent. And now finally, let's just talk about Bitcoin and Ethereum as we wrap this up. Bitcoin and Ethereum, the two largest cryptocurrencies. As I mentioned, both of them are up really big this year. Right now, as I do this podcast, Bitcoin up around, it's currently about $28,300. Ethereum is trading just below $1,900. But again, both of them are up really big year to date. Bitcoin up 71%, Ethereum up 57% year to date. We believe that we're in the early innings of a very big bull market in cryptocurrency that's going to go through 2023 into 2024 and then all the way into the beginning of 2025. So we think these are the early innings of a very big bull market in crypto. Now, many of you know we've been long crypto. We've been talking about crypto on this show for over a decade. Try to find a podcast out there that has been talking about Bitcoin for over a decade. Good luck. You won't find too many of them. Our members and people who've been listening to this show, they knew about Bitcoin when it was trading for less than $100, right? And we talk about this stuff and we continue to talk. So when I say I expect Bitcoin to go up, I'm not simply saying, that, I heard somebody thinks that it's going to go up. We are long-term investors in the space, and we've been helping people with crypto for over a decade. And we expect Bitcoin is going to go up this year. We expect it's going to go up in 2024, and we expect it's going to go up into the beginning of 2025, probably hitting a peak Bitcoin of around $275,000 is our forecast for 2025 on Bitcoin. That's a 9 or a 10x from here. So we're suggesting there's a lot of potential upside there for Bitcoin as we go forward. And that falling dollar is going to serve as a tailwind, for all of this. So there's a quick wrap up of the markets as we're looking at them. Stocks, commodities, gold and silver, oil, and then also cryptocurrencies. We also talked about ETFs. I mentioned to you, sugar was our number one ranked ETF right now, but it won't always be. And you won't be alerted if you're not a member about what the next ETF is going to be. So if you want to be in the know, if you want to be on top of this stuff and you want to be alerted by us on what we see coming and also what we are currently watching with trends, you've got to become a member. Just go to followthemoney.com/join. Take a 7-day free trial. Check it out. See what you think. We got a lot of stuff there for you to check out. Lots of videos, lots of education, lots of courses. We think you'll love it. Check it out. followthemoney.com/join. And I'll look forward to seeing you on the other side. All right, friends. Well, that brings us now to the end of today's program. I sure hope you enjoyed today's broadcast as much as I did. And as always, I like to leave you with a final word, this time taken from the book of Proverbs, chapter 22, verse 9, which says, "He who has a generous eye will be blessed, for he gives of his bread to the poor." These words remind us of the power of generosity and the potential that it brings to give blessings into our own lives. When we give freely and generously to those in need, we not only improve their lives, but we also create positive ripples of impact that can spread far beyond the person we have blessed. So our acts of kindness and generosity have the potential to inspire others, to challenge others, and most importantly, to grow ourselves. That we don't use money simply for what it can do for us, but we instead use it as a tool to not only help ourselves, but to help others as well. And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted